Good. Hey, how's it going, everybody? I'm going to chat just a little bit on my personal rules as a trader that I go by. And a while back, I actually went out and I bought a book. Not like an actual book. I meant to say I went out and bought a notebook. And I bought a green notebook. One, because green represents money. And it's a hardcover. And this is my Trade to Trade Well Knowledge to Success stock book. I have wrote down my personal rules anytime I go into a trade, anytime I exit a trade, if I think I'm going to go and buy or sell, if it's going to be a day trade, a swing trade, if we're talking about volume guidelines, the whole 10 yards I have right here. And I am making this video to talk about it. So, who is excited for me to talk about my own personal rules for trading stocks? I know I am, and I want you to be too. With that being said, let's jump right on in. Let's see. Checklist before buy. Protect your principal. The biggest thing that I could say is to protect your principal. What is your principal? It's how much you have to invest. It's your capital. It's a whole lot of different things, your principal. Now, what this means is you do not want to put, I guess in simple terms, your entire farm into one single company or one single stock. There are many reasons for this. When you do that, you are betting the entire ranch. You are putting all of your eggs in one basket. And in the incident that one stock that you just put your entire principal in, if that stock goes down, even just a little bit, you could easily, extremely easily, completely destroy your portfolio. I have got to tell you, you do not want to be in that situation at all. Stay away from it. The rule of thumb that we go by is you do not put more than 10% of your capital into a single trade, and that is to protect your principal. If you follow this rule of not putting anything more than 10% into a single stock, into a single company, you will be profitable. And that is extremely important. You want to be profitable. You do not want to be lucky. You do not want to gamble. You want to be profitable. And what that means is to make a nice steady income from investing and trading stocks. You do not want to get lucky off of one stock and say, oh my God, I made a few $1,000s today, and that very next week you try to do the same exact thing by putting all of your eggs in one basket, and the entire stock goes sour, and now you're sitting right back at where you were were. You do not want to be in that situation. You are not going to go anywhere. So the biggest thing is to protect your principal. Every time you go into a trade, know exactly why you are going into the trade. The second thing that I'm going to talk about is trade to trade well. Now you might wonder, what does that mean? Trade to trade well means this. You do not trade to make money. If you are sitting there and you are in a stock and all you can watch is the money grow, and you're sitting there watching go and go and go, you're going to get too greedy, and you're going to want it to keep growing, and you're going to miss excellent sell points. And by missing excellent sell points, you're going to watch all that money that you just saw grow now shrink and come back down to the same price you just bought it in. The idea of trading to trade well is to focus on the stock, the charts, what's actually happening in the market, and to set aside how much you are making. If you're sitting there and the stock is going up and up and up and up, and all you're looking at is how much your money is growing and not what the actual stock is doing, you're going to miss out the chance to sell, and it's going to plummet and fall. So trade to trade well. Keep your eyes on the stock and know when to sell. That is a very, very, very important part. Now, we're going to talk about why am I entering this trade? This is a very good question because you want to know exactly why you are entering this trade. If you are entering a trade because so-and-so over there behind you said, oh my god, the stock's going up, and you overhear that and you go and look and, yeah, you know, the stock is going up, and then you buy it just based off of that, and you're not looking at the news, you're not looking at catalysts, you're not looking at anything besides that guy saying, the stock's going up. There is no reason that you should buy a stock based off what somebody else just said. You do not want to do that at all. You do your own research, you do your own technical analysis on the charts in the stock. You have to know exactly why you're entering a trade. If you do not know every single point you are entering a trade, then you should not be entering it. I could go around and somebody would be like, I'm invested in stock company XYZ. And I'm going to look at them and I'm going to say, what made you enter that trade? And 9 times out of 10, they say, because a friend decided to tell me that it was a great buy and it's going to grow. So you're telling me you're going to put your money, your capital, your principal, everything that you own because somebody said it's going to go up. I'm telling you right now, the stock market does not care about feelings. The stock market does not care about you. The stock market is ran by extremely intelligent computers and things that we don't even know about. So why would the stock market up on Wall Street be looking down and going, because this guy said it, I'm going to go ahead and help this guy go out and grow his money? That's not at all how it works. The stock market will chew you up and spit you out. With that being said, you have to understand why you're entering a trade to the T. Now, I can go ahead and show you exactly why it is that you want to enter trades, and I'll go ahead and upload a video on that exact topic, because that's a very good topic on when, why, all of those really great reasons. Now, does my trade coincide with the present market trend? The present market trend. What is the overall market doing? You can have for a few weeks at a time the market overall doing excellent. It's growing, it's making all-time highs, everybody is very happy, and so you have to go into a stock that coincides with the present market trend. Why would you enter a stock if it's going down? You're right. Why would I? You wouldn't. But then why do you? You have to know why and coincide with the present market trend for that exact reason. You have to know, is the market these days going up? Is the market these days going down? And with that said, if the market is indeed going down, for example, right now, the last 3 weeks, we have seen the market plummet. Very hard, actually, and believe it or not, it has tanked very heavy. And with that being said, the only way that you would go about this situation is being within the ETFs, the exchange traded funds, which pretty much inverse the opposite side. So there are stocks out there that if the entire market is going down, then this particular ETF will do the opposite and rise. And when the market comes low and this stock is high, they are going to pivot and set out key reversal patterns which you need to know. I can explain those in a different video as well. But what's going to happen is they're going to get too high and the market's going to get too low, to where a whole bunch of buying pressure is here and a whole lot of selling pressure is here, and they're going to pivot and practically do the opposite. So that's when you sell out of the ETFs that are going against the market, and now transfer that money into these stocks that are going to start with the new present market trend to come up. And that is a very good point on does your trade coincide with the present market trend. Now we're going to move on to, do primary market indicators support my decision? Now by this I'm talking about the relative strength index, the MACD, volume, Boiler bands, and all of that good stuff. When you're looking at a stock and you want to buy it, is each and every single one of those indicators reading a buy signal as well? For example, the RSI, it's a perfect and excellent indicator for telling you if the stock is oversold or if it is overbought. So if it is way up there into the overbought territory, why would you buy it? There are a few reasons why you might buy it, is because sometimes it can be so high and trading at new highs and new highs and new highs that the RSI never comes down enough to cool off and make it look like a reasonable buy point. But if a stock is really doing that, it's going to be moving dollars a day, and it's going to be extremely volatile. And with that stuff, what is extremely volatile going up can have the reverse effect and being extremely volatile coming down. So you want to pay very close attention to all of that. Now, is my entry point technically perfect? There are many great points which are perfect for entering a trade and exiting a trade. And the easiest way I can explain this is they are called support lines. A support line is something that a stock bottoms out at when it is on a channel line moving up in a healthy and bullish uptrend. Now, in the instance that it is first starting off, you need two key points. It's going to come from where the stock is sitting up, and it's going to come back down. And if it hits this second point and does not continue to go down, but if it continues to rise, you're going to have the start point and the second point. And this is where you can now then draw a support line. You're going to literally, on the charts, draw a straight line that is going to run from the bottom of those lows, and it's going to run all the way up the graph, also known as a chart. And that is an excellent buy point when it bounces off of this straight line called support. And in many cases, it's going to come up, come back down, hit support, come back up, come back down, hit support, come up, come back down, hit support, and so on and so on. So you catch it within the first 1 to 2 bounces off of the support level are excellent, great entry points. And a great, excellent exit point is for this one simple reason. When it is bouncing off of the support nice and easy, and then there will come a time to where the stock actually drops below the support line up here, when it's overvalued, it's overbought, it's expensive now, there's not a whole lot of eyes on it, nobody wants to buy the stock at that price, so it's going to have to come down quite a bit for it to look reasonable to even buy again. And once it breaks support, that is your excellent exit point. So you're going to primarily catch the stock trading at least $1 to $2 above the low, and are going to get out of it $1 to $2 below the all-time high. And this is an excellent strategy on, is my entry point technically perfect, along with an exit point. Now, one thing as traders, we question ourselves. Do I have a rational, thought out game plan? This is extremely important because you have to make a plan and trade your plan, if that makes sense. So the easiest way that I can explain this is you have to literally write out your game plan on what you're going to do with this stock, because your mind can sometimes get in the way of what you actually wrote down. In many instances, I will be invested into a stock and I will have it written down. And if I were to have just followed what I written down every single time, these trades would have turned out amazing. But in some cases, it'll get to a point where I get too greedy or I get too fearful, and I either exit out or I hold. And I do not follow my rational, thought-out game plan, and therefore it does not go the way that I want it to. The next and final thing that I'm going to talk about that is here in my Trade to Trade Well Knowledge to Success stock notebook is this. What is my exit price if my trade goes sour? That is an excellent question. What is your exit price if a trade goes sour? Meaning, if you just got into a stock at say $5, you just entered a stock at $5, the stock is trading at $5, and then all of a sudden it just starts falling out of nowhere. It's falling down into $4.50 price range, it's falling lower into the $4 price range. Next thing you know, it's like $3.80, and you're now down $1.20 from where you got in. What is going to be your exit price? You can go about this in two different options. One, you can set a stop loss, which means you set a specific price to where if the stock falls, it will automatically cut you out. And yes, you will be stuck with that minor loss. Or you can hold it. Now, it can take quite a while for a stock to come back up to the price you bought it at. But which would you rather do? Would you rather be stuck with a minor loss, or would you wait the time it takes for it to come back up, for it to go higher, and then profit? So those are two questions that really gets a lot of investors, and it's a very great topic to talk about, because sometimes you have to decide right then and there on the spot which one you're going to do. Thank you very much for listening. If you want to know more and get into great discussions like this, I have this book filled of pages and pages of what I call a checklist before buy. If you want to know more, go ahead and give me a like, subscribe to my YouTube, and go and follow me on Apex Trader Facebook group. Thank you and have an amazing night.